Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the TGI. Thank God it's Friday, the 12th of January, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. We're going to go for our usual regular run through here today. We're going to take a look at the calendars, both the macroeconomic data calendar plus the micro calendar, the earnings calendar, as we kickstart the earnings season in the US today with many of the large financials slash banks reporting today. We're also going to take a look at the major news wires. We're going to take a look at the macroeconomic fundamental central bank geopolitical events that are shaping financial markets right here, right now, and we will also take a look at the charts and see where the potential trigger points are for you today in the markets you primarily trade, the ES S&P 500 and the NQ, the Nasdaq 100. So we're going to take a look at those a little bit further along in the webinar. So first of all, let's start with some of the European briefing. Now, remember, I'm encouraging people to start to use this. This is below where you are. If you're on this webinar, I'm guessing you want to know a little bit more about fundamentals and you want to understand a little bit more macroeconomics can impact financial markets. And this is a good resource right below. With our partners at LiveSchool, it's a facility we have from them where they share some of their news and commentary. And so you can see in here the European briefing, just below where you are now. They're the three panels. If you're watching this streaming live, that is, and not on the catch-up. But even if you're watching on the catch-up on the Trade Day members area, you'll see below you have the areas of technical analysis reports, which I'll come to shortly. My market chart is technical analysis reports. You also get to see the fundamental reports that we put out on the weekend, that are the look back and look ahead for the week. And then there's also this fundamental daily reports in here, the European, US, and Asia briefings from LiveSchool. So we're looking at those in here now. So the headline, really, the big news overnight, we've had these US and UK airstrikes on targets in Yemen in retaliation for the various activities that have been going on in the Red Sea. That is obviously heightened tensions, and the main outcome from that with regard to financial markets is instability. Markets don't like that, so stocks a little lower, but they're also being pulled lower in here this morning by the fact that the banks have reported and they've not gone too well, but we'll talk about that in a second. And then the other thing in here is obviously this in here is disruptive of the Middle East. Middle East disruption equals higher oil price. Oil price has surged higher, and that surge higher in the oil price. In here, you see in here, oils jump as US airstrikes against the Houthi, I think, fans Middle East tensions in here, pushing up the price of oil, and obviously higher oil, potential higher inflationary pressures resuming, and those inflationary pressures are negative for the global economy and negative then for stock indices. So stocks wavering because of these airstrikes, both through the the extra volatility and the uncertainty that it brings, but also then that brings higher oil prices. The other couple of things I want to highlight, China's consumer prices in longest streak of decline since 2009, and China's exports dropped for the first time since 2016. These are a couple of pieces of data that I pointed out in yesterday's webinar that were coming out late last night. And if I go to the calendar in here, it won't be on here. It's going to be on yesterday's calendar. And we look at the bottom in here, you see the data down at the bottom. So here's the trade data, and here's the where's the inflation data? Up here. Here's the inflation data. So the PPI data minus 2.7. Remember, PPI producer price index in here worse than expected. So that's actually if you're in the West, that'd be seen as a positive, right? Because lower inflationary pressures are in an inflationary environment that the Western economies have been enduring for over the last year. That would be seen as a positive. When you're in a deflationary environment, as we are seeing in China, as China has been in over the last year, hasn't really come out of a post-COVID, hasn't seen a strong post-COVID recovery. And we're seeing deflationary pressures, falling prices, particularly what we call here factory gate prices, the producer price index, the inputs, and that's not positive. That just shows a weakened economy, okay? And so we're not liking that. And also you can see in here we missed also on the month-on-month CPI, the consumer price inflation data. So these were negative for the Chinese economy, and negative for the Chinese economy is definitely not a positive for the global economy, okay? So we got that came through, and then also the trade data wasn't particularly great either, as well, as we saw on those headlines. So trade data plus the inflationary data out of China highlighting a fragility still to the global economy. So that's putting a little bit of downward pressure on top of what we've had because of the oil prices, but going higher because of the strikes that we've had overnight in here on Yemen. And then also on top of that, then we've got the and I'll come to that shortly when we look at the earnings calendar. Even though some of the earnings kind of looks quite green, some of the guidance in those earnings reports from the major banks in here hasn't been that great, and then that's put downward pressures on the bank stocks. So bank stocks about depending, we'll run through in a second, but they're about 2% down this morning, and that's tugging down on the broader market as well as we kick off earnings season. So just back to the calendar in here, I'm going to go back to today. So that was yesterday. Looking into today, we've had some European data as well, UK data in here and European data. Not had too much of a significant impact. There is a European event. Christine Lagarde, who is the head of the ECB, has been speaking and had a dovish shift, and that's actually boosted European stocks this morning. So European stocks actually doing okay despite global stocks being pulled a little bit lower in here today. But looking into today, what do we have from the US for you guys trading today? In just under 1 hour's time, 54 minutes to be precise, we have the PPI data. Now, given that we had the CPI data, which I'll talk about a little bit briefly shortly, I'll talk about it now. The CPI data yesterday was slightly hotter than expected, not aggressively hotter. And I'm going to sort of jump back to yesterday's data in here. So we go to the CPI data out of the US. You can see most of it in green in here, so above expectations. We don't want to see that. Green is not good in this case because we want to see inflation coming data. What the green is actually means it's positive for the US dollar, because it's in terms of, this is very much focusing on how it's going to affect the currency, but it's not positive for the economy in here. We want to see these numbers in red, and you can see mostly in green. They weren't hugely above expectations in here, about a tenth in most places, and actually the core CPI month on month came in line with expectation. The year on year number was a tenth higher. The month on month data was on the headline data was a tenth higher than expectations, and 2/10 higher on the headline data on year. The concern is it's kind of been sticky. We want it to continue to move down towards this kind of 2% level. As it's got to these lower levels now with a 3 handle, with a 3 big figure, inflation has come a little bit sticky in the US and sort of won't budge, continue down to what we're looking for, which is like more closer to 2%. So that was a little bit disappointing. But as you saw yesterday, you guys probably would have been trading it. Both US stock indices and the bond markets are very choppy. They chopped up and down. The market didn't really know what to make of it. It wasn't too hot. It's still moving, kind of ish in the right direction. But, we are seeing it sticky. But I think what it shows is an underlying resilience, particularly to the stock market in here, because the stock market could have easily sold off on this quite more aggressively and didn't. And the actually short end bond markets, which I'll come to shortly when I look at the charts, actually came out of it quite well. And if you actually would go and look at we'd expect this to mean that the Fed maybe weren't going to be as accommodative with their potential rate cuts. But the actual CME Fed tool in here tells us that it's pointing to more likely a rate cut coming now in March, as opposed to less likely. And I think also that the tensions in the Middle East, that could derail, because it could cause inflationary pressures, but it could also derail the global economy in here from a potential soft landing. So that's probably more likely to make the Fed shift to more dovish with the issues we're having in the Middle East and at the moment, and the potential higher oil prices. Even though they can be inflationary, they can also have a negative impact on growth. And so this may be more likely to see the Federal Reserve move to easier monetary policy. So we'll come to that as we move forward as well. So going back to looking into today, we do have that PPI data. The PPI data is really like the kind of the poor cousin, really, of the CPI data. It's unlikely, unless it's very out of line with expectations, it's unlikely to have a significant impact. As it gets released, it can have an impact, but then after that, it's probably going to have less of an impact. And then at 10 o'clock Eastern time, we have Kashkari on the wires. Kashkari is going to be interesting. Remember, if we go to our Hawk Dove sheet, so I would suggest that you bookmark this. So Neil Kashkari, okay, if we look at our Hawk Dove sheet in here, he's right down at this end, the hawkish end of the spectrum, okay. He's more of a hawk, meaning he's more likely to either increase rates or he's less likely to want to cut rates, okay. So it's going to be really interesting to see what Kashkari has to say today, because what we're looking for is the hawk to say something dovish or a dove to say something hawkish, right? When a hawk says something hawkish, big deal, right? That's what hawks do. They say something hawkish. But if Kashkari, has definitely been one of the more hawkish members of the FOMC during the rate hiking cycle, if he starts to shift more dovish, it could be a signal that the Fed are going to move to an easier monetary policy sooner rather than later. Maybe we do get that rate cut in March rather than further out into the year. So Kashkari on the wires at 10 o'clock today. Let's move on at the earnings report. So you can see this mostly looks green, which you'd think of is mostly positive, so beating expectations. But it's the comments and the extra data behind the headline data that has caused the banking sector to move lower in here this morning, despite, if we look at JP Morgan, Bank of America, BlackRock in here, all beating expectations. Most places in here, actually, revenue slightly below expectations in here for Bank of America, and the EPS, earnings per share, slightly below expectations for Wells Fargo, and also United Health beating expectations. But if I just jump forward to, where are we in here on my stock market? I think it's in this one in here. Yeah. So in here, the stocks of the biggest US banks, including JP Morgan, Chase, and Wells Fargo, fell more than 2% after missing trading revenue expectations. So it's the data behind the headline data that's caused stocks to move down, the banking stocks to move down this morning. We're down between 2 and 3% on some of these major stocks in here this morning. Now, they could be being tugged down by the broader market as well, because the broader market is down because of the military strikes, okay, that we saw in Yemen. However, this is definitely the underperformance from the banks this morning is definitely because of those concerns around some of the data behind the headline data in here for those US banks. And also, if we go and look at Reuters, they're covering the same thing. You look, Bank of America profit shrinks on 2.1 billion of charges. United Health also falls on higher than expected medical. So you look at the headline data in United Health. If I jump back to the earnings calendar, it looks green and green, but it's the data behind the data that's causing United Health to react more negatively in here. And if we go down, look, Bank of America down 3.3% in pre-market trading. Fourth quarter profit shrank, and then JP Morgan Chase 2.6%. Lenders quarterly profit fell after setting aside $3 billion to help refill the FDIC's fund in here. So, etc., etc. I'm not going to go through all of them, but a negative reaction to the kickoff to earnings season, with the banking sector down this morning and weighing on the broader market as well. Let's dive in now. Just actually going to run through the rest of the headlines before we start looking at any of the charts. So US inflation picks up. That's reviewing yesterday's. We know about that. Already kind of covered that already in here. Federal Reserve Bank of Cleveland, Loretta Mester said it was a premature to consider cutting rates as soon as the US central bank's March meeting. So Mester pushing back against rate cuts in here. But and Mester, if we look in here more in the, it's definitely down at the more hawkish side in here, but nevertheless slightly closer to the middle than, say, Kashkari. So pushing back against their rate cuts in here potentially as early as March. Red Sea conflict, we've already spoken about this. We saw Brent up 3% in here this morning, a jump higher across crude, West Texas Intermediate as well, WTI, also jumping higher. Bitcoin, we've already discussed that, really not impacting on the broader markets that we're talking about. And there's that deflationary story that we've already spoken about, re China and big bank earnings. Again, this was written before those earnings were released. So in here, we've obviously seen that data now. So obviously not great in here. Talking in here about the PPI data, and Kashkari is coming out today. What else do I have for you? So we've already spoken about here oil surges. So WTI is up 4% because of those airstrikes on Yemen. We've already spoken about the banks in here. If we go and take a look at Reuters, similar story. We've gone through this already. Futures down this morning after bank earnings, and looking at the PPI data now going into today. Markets ignoring inflation, red flag. So this is Michael Hartnett, ex-colleague of mine when I was at Merrill Lynch, Bank of America. He's highlighting that potential red flag. Geopolitical measures are inflationary. Everything that we've been talking about just now, and etc. Potentially in here, I'm going to see upticks in here in inflation, and he's red flagging that as strategies like bonds in particular come back in 2024 for bonds in here. What else do I have for you? Oh, tops 80s bucks. We've already kind of covered that. We already covered the China story. China's worth deflation streak in 14 years, putting pressure on the PBOC. You know, I think bigger picture, we will see stimulus coming from the PBOC, the People's Bank of China, and I think, you know, we will see the China market outperform from a low base, having been underperforming really post-COVID. Saudi Arabia calls for restraint after the airstrikes on the Yemen in here, and all the rest of the story is really about oil jumps 4%. We've already got that in here. Oil soars as US strikes, you know, etc., etc. Just a quick note on what I was saying there about Lagarde. So ECB, Christine Lagarde in here, president of the ECB. Rate cuts to occur. It's clear inflation has fallen to 2%. Definitely a dovish tone. So Lagarde also mentioning Trump as well. Trump re-election would be a threat to Europe, but interest rates likely have hit peak. But Lagarde cannot say when rates will go down, and looking at likely rate cut if inflation confirmed at 2%. So Lagarde definitely a slight dovish shift in here, and that's helped European stock indices this morning, as highlighted here. So European shares gain on rate cut cheer, and Airbus also up in here, helping European stocks higher. Let's go take a look at the CME tool. So this is on the March in here, and remember that we've said this has been hovering around 65 to 70%. Well, now we're above 70% chance now. If you look over here, this is current rates. So current rates are currently, the target rate is 525 to 550. This is 525 to 550. And you can see we're sub 30% in here. So we're 28.6. So over a 70% chance, over a 71% chance in here that we get a rate cut. So this is probably, I think this is the highest it's been. And we can go and take a look at that on the historical. So take a look at the historical. So we're going to look at the 500 to 525. If I then go here and get rid of all of these other, what's the chances of 500 to 525? Oh, there is that one there. So you're actually not back up to its highest point, but getting up closer to its highest point in here. So we have been up as high as nearly into the high 70s, okay, but back above 70 in here, having dipped down to closer to 60% chance of a rate cut, and moving back above 70% in here with the highs at the high 70s in here. So percentage chance of a rate cut moving back towards the highest that we've seen in here. The highest point was back, you know, after the going into the Christmas period, after we had that big spike up here. This is when we had the Fed in here, you know, we were seeing more around 50%, and after the Fed in here leaping, 40%, leaping higher, the chance of a rate cut in March, back after the Fed meeting back in the middle of December, and since then we've been up to nearly high 70% chance in here of a rate cut, and now moving back towards that kind of number. So actually, after yesterday's data, despite yesterday's data, the CPI data being slightly more inflationary than expected, we've actually seen the chances of a rate cut coming earlier rather than later in March, having risen. Let's run round through the overnights in here. So Nikkei surging higher, having broke through 35,000 for, what was it? It was the first time in 30 plus years, right, over 3 decades. We've seen the Nikkei push higher again, 1.5% overnight in here. Hang Seng slightly dipped, no doubt not helped by those negative numbers that we saw out of China. European exchanges are up, you know, this dovish tone that we saw, so notably up in here. So we are getting a slight divergence in here between the US and Europe in here. Often Europe just playing catch up with whatever the US done, but yesterday US was choppy, remember, didn't really go anywhere by the end of the day. But European bourses are higher in here this morning. The UK FTSE 100 up at 0.6, the German DAX up over 0.5%, and the French CAC nearly 0.75% on the back of the rate cut hopes after the comments from President of the ECB, Christine Lagarde. And then moving on to the overnights in here. So we did pretty much unchanged yesterday on Europe and US exchanges. Slight dip. We're about between 1/3 and 4/10, 3/10 and 4/10 lower across the Dow, S&P, and NASDAQ going into this morning. And pulled down by, as I said before, by the banks, pulled down also by the strikes on Yemen in here due to the uncertainty. Quick nod to the charts. Despite the dip lower in here, you know, if we go back and look at my reports from last night, you see we're still bullish in here despite the chop yesterday. So we chopped significantly down on both NASDAQ and the S&P, and then significantly back higher. And yes, we've dipped slightly in here this morning, but the underlying theme in here for me is bullish in here. I'm still looking to, we said yesterday, buy the dip, right? I said my two views were if the number's better than expected and it breaks higher, the CPI data, we spoke about buying the break higher. The other thing we spoke about is if the number's worse than expected, but not too much worse, and that's what we got, it was to buy the dip. And yesterday we saw a notable dip and then a notable rebound for the markets to end up unchanged. So for me in here, I think even though we've had this slight dip in here this morning, we're still coming into today. I'm looking to buy that dip. I don't think it's going to completely, what we're seeing on the overnights are really not going to derail the fact that US stocks are heading north, even though the banking data wasn't great, even though the threat from the Middle East tensions isn't great. The market's still performing, the equity market's still performing pretty well. So underlying theme is positive. The other thing to point out, just going back to my analysis here, is look at the US 2-year. So the US 2-year, as just similarly to what we saw on the CME. Remember the CME Fed Watch tool, more chance for a rate cut. This is the short end, right? And then, it's wrong tab. So on the 2-year, we've been very much in the range. This big spike higher here in the 2-year note. Remember the short end of the bond market. The short end is more driven by the central bank. The longer end is more driven by the economy. So the 2-year note definitely more driven. Is similar to looking at the CME Fed Watch tool, right? It's more driven by what the expectations around interest rates are in the short term. And if we look in here, we had that big spike up here through the middle of December. That was on the Fed. Okay, so we saw the big spike, and then the market's been chopping in a range in here since then. But you see, earlier this week we went notably lower, and then we rejected that rebound. And then yesterday we were up again. Okay, so short end bonds in here, we've actually turned back bullish in here, seeing upside bias in the short end, despite in here being bearish on the slightly longer end and belly of the curve in here at the moment. But even here, we're seeing potential signs for upside on the other bond markets, but notably 2-year notes in here looking more positive, pointing to the top side again. And that's important for the stock indices if the short end, because they're very much focused on shorter term interest rates rather than longer term interest rates. So that should be bullish for the stock indices. So going back to the charts here, despite the sell-off we've seen this morning, we have had a sell-off and a rebound in here already. So we go to the 30-minute chart. So there's the chop fest that we saw yesterday, chopping on the data itself, then a significant sell-off, then a significant rebound, back lower in here this morning, but then rebounding now. And I think, this is the bounce. I think there is real risk to the upside going today. That's on the ES. Similar on the NASDAQ. We saw a chop higher, a big chop down, and then a significant rebound yesterday. Consolidation down lower this morning, after those airstrikes, after the banking data, but rebounding now in the last hour. So I do think the risk in here is back to the top side. Back above like 16,980, 990 on NASDAQ, things look a lot more positive. Back above the 4820, 22 area on S&P, things look a lot more positive. So still coming into it with a bullish theme for me going into today. Any questions? If not, I'm going to wrap it up there. I'm not only going to... one thing I want to finish on. I'm 99% sure on this, but I'm going to quickly just jump back to my calendar in here. You guys in the US can help me out really with this, but I'm pretty sure it's where are we? It's MLK Day on Monday, right? So markets, I think we'll put out a note. Check in the forums. We'll put out a note. I think we've got some kind of. Let me just double check in here. CME calendar. I think we've got slightly shortened trading hours, okay, for Monday, as I remember, 2024. Yep, MLK Day, yep. So 14th to 16th of January in here. So there will be slightly shortened trading hours. I think cash markets are closed. Let me see in here, NYSE. I think cash markets go. We'll put out a note on this, but I'm pretty sure cash markets are closed. Yeah, MLK. Yeah, so cash markets, I think, are closed on Monday in here. So we could see a lack of liquidity on the futures. It's going to be certainly some shortened trading hours. So do be wary of that. We will put a note out. We'll send an email out as well. But do be wary of the changing trading hours. Remember to be closing positions because the trading day will end sooner rather than the normal times on Monday. So be careful of that. my advice, don't trade. My advice is don't trade. Lack of liquidity, lack of information, no point in being in the markets. If you are going to be in, please do note when the trading hours are and be wary of the lack of liquidity. So, just to point that out. On the back of that, there will be no webinar on Monday as well. So we'll put a note out on that as well. But no webinar on Monday. It's a US holiday. Cash markets are closed and we have limited trading hours. I mean, I can share this with you anyway in here. I don't know whether that'll open in a... Yeah, I mean, I can share this one with you in here. You need to select in this here for the trading hours. Okay, so I'll share that with you if you guys are on the webinar now. You can take a look at that. About cash markets certainly closed, so just be wary of that. Okay, I don't see any questions coming through. I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you not till Tuesday. Have a great weekend as well. Enjoy MLK Day if you're in the US, and we will be back with you on Tuesday for the next webinar. Looking forward to another week. Take care. Bye.